everyone, and welcome to today's webinar, Real Estate Market Update in second half of 2022 and Opportunities in 2023. So before we start our webinar, we have information in regards to today's session. So the first one, the audio and video for webinar participants are being disabled to avoid any noises, and we will only enable audio and video for our panelists. This webinar is being recorded, and we will share the recorded file and presentation slides by tomorrow. We will have a question and answer session at the end of the webinar, but please feel free to type your question in the question box. And although we may have a limited time to answer to your questions, we will send unanswered question to your email inbox. If you need any help with the webinar, please type your question in the chat box and our team will help you. And along with the recorded version that we're going to send you tomorrow, we will send survey link for you to fill, and we appreciate if you have the time to fill out the form. So to start our webinar session, I'd like to introduce to everyone the Colliers expert that's going to speak today. We will have our Managing Director, Bapak Mike Broomell. He will deliver his keynote speech to open the session. And then will be followed by Pak Steve Atherton, our Head of Capital Markets and Investment Services, with Ibu Monica Koesnovagrill, our Head of Advisory Services. Next will be followed by Bapak Ferry Salanto, our Head of Research Services, and Bapak Bagus Adikusumo, our Head of Office Services. And today also together with us, we have our Head of Retail Services, Bapak Halsema, our Head of Industrial and Logistic Services, Bapak Rifan Munansa, our Head of Residential Services, Ibu Lenny van Es-sinaga, and last but not least, Bapak Satria, our Head of Hospitality Services. So without further ado, please welcome our keynote Broomell. The floor is yours, Pak.
Thank you, Ruby. Selamat sore and good afternoon. I'd like to welcome you to the last Colliers webinar for the year. It's good to see a lot of familiar faces and names, and we're thankful that you were able to attend this webinar to hear our various experts talk about their insights in regard to the property market this year and their predictions for next year. Of course, the real estate market is greatly impacted by the economy at large. So as we talk about the forecast for next year, it's a little bit difficult because I think most of us are uncertain about what's going to happen with the economy in 2023. I've heard several forecasts recently which talk about the fact that the first half of the year will be difficult, but the second half of 2023, we should be in recovery mode. So I hope that's true, but who really knows? I would like to briefly share with you some of my observations, partially based on the research that we've done, and partially based on the day-to-day contact that we have with property occupiers, investors, and developers, which tends to be a little more up-to-date than the research that we can do, since that's looking backwards as opposed to looking at what's happening in the present time. And after I do my brief overview of the various markets, we will have the experts in those various asset classes that will be giving you more detail and talking in more depth about what I've discussed. What I've done is I've grouped the various sectors into three areas. One is the unhealthy sectors, which we'll talk about first. Secondly, we'll talk about the moderately healthy sectors. And then finally, we'll talk about the most healthy sectors in the real estate market. In terms of the unhealthy sectors, unfortunately and understandably, that tends to be office. We already had low occupancy in the office market before the pandemic began, and it has dropped, occupancy has dropped even further since then and is now below 70%, which is the worst I've ever seen it in the 30-some years that I've been in Indonesia. And what's happening is it may even get a little bit worse because we have more space coming on the market in the next few years. The demand for office space, as you might have realized, is quite depressed because of various factors. Some companies have gone out of business during the pandemic. We also have a situation where we have hybrid working by many companies, and also many companies have reduced the space they take because of the hybrid working situation. So it's a tenant market and an investor market. Apartments, there's an oversupply of strata title apartments for sale. The office market is showing some promise with the return of expats. So in terms of leasing space, that is a slightly positive thing. And then also the government has on November 1st released the regulations allowing foreigners to have Hak Milik title on top of, for strata title apartments on top of HGB title land. So that's the same right now that Indonesian citizens have, except foreigners are having to buy apartments or houses that are above a certain price range. The moderately healthy sectors, we have retail, mostly F&B, which is food and beverage has seemingly revived, and most recently even we see some revival in the downtown area. Hospitality, hotel performance is better than expected, especially in Bali. And the healthy sectors, which have continued to be healthy over the last year or so, have been logistics, data centers, and affordable landed housing. So we have also identified several alternate asset classes that might be worth looking into in 2023. And we would like to have our experts talk about those in more detail. So without going into any more detail, I'll turn it over to our experts, and hope you enjoyed today's seminar. We look forward to being in contact with you. And if you have any questions, please do not hesitate to reach out to me or to any of my colleagues, and we'd be happy to help answer whatever questions you do have. Thank you.
Okay, thank you so much, Pa Mike. So now let's start our webinar. So please welcome Pa Steve Atherton and Ibu Monica Koesnovagrill to present about the investment market. And the floor is yours.
Okay, good afternoon, ladies and gentlemen. These days, everyone is talking about inflation, the war in the Ukraine, rising interest rates, rapidly adjusting property markets across Asia and around the world. So let's dig in. On this first slide, on the left hand, we can see a comparison of trending inflation rates in the US in the red, EU in the light blue, and Indonesia in the dark blue. Around the beginning of 2021, we can see the US inflation rate moving up first, followed by EU and then Indonesia. Overall, the EU has touched the highest inflation rates at over 10%, with the US starting to trend lower from the 9% range to the 8% range. And now Indonesia is floating in the mid 5% range. Central banks around the world have responded to the quickly rising inflation rates. With the US inflation hitting the highest level in 40 years, the Federal Reserve initiated a series of rate increases since early 2022. The chart on the right-hand side shows the low base rates in the USA and EU and the rapid increases over the last 9 to 10 months, with Bank Indonesia also raising its 7-day reverse repo rate another 50 basis points to 5.25% in November. With inflation recently dropping in October in the US, many market observers expect the next amount of rate increase by the Fed to be less. Hopefully, other central banks will follow. Anyway, what does this all mean for the Indonesia property market? In short, we don't expect the global recession to be terrible compared to past recessions, and we expect even less impact here in Indonesia. Nevertheless, we will still face higher interest rates, higher construction costs, and ultimately higher borrowing costs for end users, investors, and developers. All of these higher costs will put pressure on developers to raise prices and will make qualifying for mortgages more difficult. In fact, according to a recent internal survey of tenders between Q1 2019 and Q4 2022 by quantity surveyor firm Reynolds Partnership, we have the following fresh data on the rise in construction costs in Indonesia. For the Jabodetabek area, the increase in construction costs for medium-rise buildings from Q1 2019 to Q3 2022 was on the order of 12.5% to 15%, so about 5% per annum. In Central Java, the increase in construction costs for low-rise buildings from Q3 2020 to Q4 2022 was on the order of 15 to 17.5%, approximately 8% per annum. And lastly, in Bali, the increase in construction costs for low-rise buildings from Q2 2020 to Q3 2022 was on the order of 17.5% to 20%, so about 9% per annum. So there you have it in terms of what the real trending rise in construction costs have been since COVID. Next slide, please. Just to paint the picture of what's been happening in the US in response to interest rate increases, you can see in this slide the 30-year residential mortgage rate in the red line increased from 3% in early 2022 to as high as 7%, and it's now dropping back to the 6.5% range. This roughly tracks with the central bank amount of rate increase, and you can see the sales of US existing homes in the light blue bars dropping in sync with the timing of these rate increases. Next slide. We don't see the same corresponding reaction to interest rate increases in Indonesia for new home sales. Part of the reason is the increase in interest rates has been less in Indonesia. You can see on the left-hand chart, which shows Q3 2021 sales in light blue, compared to Q3 22 sales in dark blue for the top 5 listed property developers here. Sales have not reduced, but have actually increased by fairly significant amounts. On the right-hand side, you can see the aggregate developer marketing sales have also increased marginally in 2022 over 2021. Next slide. This slide gives some indication of the greatest contributors of FDI, foreign direct investment, in the last 2 years. Topping the list is Singapore, then China, then Hong Kong, then Thailand and South Korea, with Japan and the USA finishing the list of the top 7 investors. So even in these challenging times, Indonesia still offers an attractive investment market for foreign investors seeking diversification and the market growth potential of Southeast Asia's largest economy. Next slide, please. So against this backdrop, we see the property investment climate in 2023 to favor landed residential. Landed residential sales, especially in the 500 million to 2 billion price range, remains healthy, and builders continue to source land for new clusters and townships in Jabodetabek. Logistics continues to get a lot of attention by foreign investors. With high land costs and competitive rents, it does seem the future logistics buildings will likely shift into multi-story buildings, like you see in Singapore and Hong Kong. We also see the data center market continue to expand. While the dominant hyperscale players have established their base mostly in the Eastern Industrial Corridor, we are also observing new players acquiring sites and planning new 10 to 20 megawatt data centers in the city center, the Fringe, and West Jakarta. With fewer real buyers in the market prepared to acquire land for vertical developments of commercial, residential, and mixed use, it's a buyer's market, but somewhat distorted by the new city plan, RDTR, where plot ratios were recently increased for many areas in the CBD and major commercial corridors. And some sellers are now even expecting more for their land than they did previously. So this is a bit of a mismatch in the market, and something that we expect to be working itself out over the next 1 and 2 years. Some niche players in Bali have been successfully building and selling villa clusters, as well as new beachfront resorts on long-term leaseholds and investment contracts. It's not the big, expensive villa market or the inexpensive condo-tel market, but reasonably priced villas that can be part of the resort inventory or used for family holidays and managed for rentals. For retail and hotel assets, we still see the asking prices remain mostly above local and foreign buyer targets. Some sellers are willing to consider selling shares in the assets with preferred returns for the new capital invested. This can be a creative way to find middle ground that works for both parties. With the few hotel assets on the market at prices attractive for new investors, there are some opportunities to acquire greenfield sites or uncompleted projects and form partnerships with experienced builders where a build to core type approach may be feasible for hotel and serviced apartments. Next slide. So here in this last slide, we do see a lot of state-owned enterprises seeking to optimize their assets, where some form of co-investment or partnership with private investors and developers can be explored. Typically, these buildings or land would not be 100% sold, but structured on some form of BOT or long-term leasehold basis. We expect to see more distressed asset sales in 2023, although OJK did recently approve further extended loan forbearance until March 2024 for industries such as accommodation, food and beverage, small and medium enterprise, and labor-intensive industries like textile and footwear. For these types of loans, lenders are not required to set aside provisions, which is intended to help keep down the number of non-performing loans. For the individual investor, 2023 will be a great year to buy affordable apartments, especially for end users who can occupy the units versus renting out to third parties. For developers and owners of commercial buildings and apartments that are under some operational pressure, this could be a good time to find new investors who can inject capital or bring management expertise to help generate additional revenues. And finally, as mentioned earlier, there is this current distortion in the land pricing for vacant land in the CBD, fringe, as well as TOD sites. But we do think serious investors will be able to identify strategic sites and acquire at prices that will look very attractive in the next property cycle. Thank you.
Okay, now let's move to Ibu Monica.
Okay, thank you, Pak Steve. Thank you, Ruby. So having seen the global condition, we now we see what's happening in Indonesia sector. Three factors will have an impact on property market: inflation and VAT, interest rates, and also political situation. Next slide. For inflation, we present here two charts. On the left hand is annual inflation rate, and on the right hand is inflation for each type of expenditure. For the right hand, we can see that the highest inflation was occurred on the transportation cost due to the high oil cost. Then this triggered off the other inflation. So in 2022 year to date, the inflation has achieved about 5%. The last time we had quite high inflation was in 2014. It is also triggered by oil cost. What will be the impact on the inflation on the property market? One is lower individual property purchasing power and higher development costs for developers. Next slide. In addition to high inflation, VAT was also increased from 10% to 11%. What will be the impact? For customers, it means that higher costs in buying property, and especially for landed houses, the cost will be much higher, especially with the end of the VAT incentive for housing in September 2022. And then for developer and investor, it means that higher development costs and also higher costs in buying property. Next slide. As also mentioned by Pasif, in facing global economy and also higher inflation, Bank Indonesia has to increase the BI 7-day repo rate. In 21st June 19, there was a decreasing trend, which achieved the lowest at 3.5%, and it was maintained up until 22nd August before it was moving up to 5.25% in October 22. Next slide, please. Then another challenge that is facing by the companies is also the application of the minimum regional salary. This chart showing the minimum regional salary for each province. Then this shows that Jakarta is having the highest minimum UMP of about 4.9 million, followed by Papua. An interesting fact is that 4 provinces in Java, West Java, Central Java, Jogja, and East Java, are actually having the lowest UMP in Indonesia in 2023. Then it will be reasonable to have labor-intensive manufacturing in these provinces. And this is also supported by high density population in these provinces. Next slide. From the challenging situation, we are still seeing the positive view, the attractiveness of investment in Indonesia. We are preparing in here investment in domestic and foreign in Indonesia. The upper part is domestic investment, showing in rupiah billion, with indicating a continuously increasing trend for domestic investment since 2010, and in the bar showing the value, and the dot showing the number of projects. Whilst in the foreign investment, the value was somehow it was quite steady at about 30 billion since about 2013. Next slide, please. This chart showing the breakdown of investment for different sectors in Indonesia for domestic and foreign. Property is classified under housing, industrial estate, and office building, which shows in the gray part. And from the ratio, it shows that property investment in domestic investment was somehow higher, about 12%, than in foreign investment, which was 7%. Next slide, please. Later on, we will show the performance of Jakarta property market for each sector. With tight market for property in general, developer has to find for niche market, for unique products. And these are some sectors that are still potential: healthcare, senior housing, student housing, education, cold storage, and fulfillment centers. If we notice that these are sectors are really related to the huge population in Indonesia as the 4th biggest population in the world. Thank you. Thank you, Ruby.
Okay, thank you, Pastif and Ibu Monica. Now we're going to move to our next sector, the office sectors, with Pak Ferry Salanto and Bapak Bagus Adikusumo. Bapak, the floor is yours, Pak.
Okay, thanks, Ruby, for the introduction. Hello, good afternoon, all. I hope you are all fine. As Ruby mentioned earlier, I will discuss about the office market. Okay. In the beginning, you heard that Mike mentioned that the sector is categorized as unhealthy sector. As you can see from the title of this chart, the market remains favorable for tenants, or in a simple way, we say it as tenants market situation. And also you can see from the occupancy slide, it has been trending down since 2019. The oversupply situation contribute most of the overall slowdown. However, other factors like the slowdown in the office space inquiry also weakening the overall performance of the office market. As you can also see the two charts in the right, it actually shows the comparison between annual supply and demand. And this emphasizes the speed of office space influx has yet to be in the balance with the speed in the office space absorption. Given the notable supply pipeline next year, we anticipate the overall market remains challenging for office landlord in 2023. Next slide, please. Okay, here we have the annual supply addition. As you all can see, in 2023, it's still a tough year for the landlord as suddenly adjust occupancy down. And then entering the political year in 2024, office will be more relaxed with no new building will be in operation, which is good to stabilize occupancy performance. From 2024 onward, supply projection will be more moderate next year. Next slide, please. Okay, now we have some charts showing the rents and prices here. Rents of premium and grade A office building tends to be stable. With the current tenants market situation, building owners continue to be adaptive and flexible. And during the third quarter, there was an indication that demand for office space are not only coming from the local company, but also to seek for office space. So in general, the current property clock cycle for office is almost in the 7 o'clock, starting to show sign of improvement. That's all from me. Next to Pak Bagus.
Thank you, Ferry. Thank you, everyone, for joining our webinar for the second half of 2022. After slightly over 2 years, every company is working under the pandemic situation. They have adapted, they have adjusted running the business in the pandemic. And we start seeing actually a lot of companies that we helped and assisted and appointed us execute the relocation plan in Q1 and Q2 2022. So majority of those companies, after renewal and relocation assessment and exercise, they executed the relocation plan. So this shows that there is actually a pickup in the office market. And then it continues until the beginning of Q3 2022. And then over end of 2023, over end of Q2 2022, and then Q4, the relocation plan, the execution of the relocation plans actually decreases. And then one of the reasons from our discussion with few of the companies is the possibility of global recession. So many companies, because of the uncertainty of a global economy next year, are becoming more cautious, especially when they're planning to relocate. They have to set up CapEx budget for movement and relocation. So they've been instructed, some of the companies that we helped and decided to stay, they've been instructed to extend and renew the lease at the current building. Not only that, when they extend and renew, they also reduce the space. So the downsizing wave of space is still continuous. It's not as large as before in 2020 and 2021, because even though we are kind of post-pandemic, COVID is pretty much under control, but still a lot of multinational companies especially continue working from home, hybrid business model. And also they reconfigure the space. So they change the space in a way where they reduce the fixed desks and open more of the mobile desks and open space. Next slide. Now, another reason why they executed the relocation plan is part of the ESG initiative. The environment part of the ESG initiative is that a lot of multinational companies nowadays been instructed by their head office to move to a certified green building. Now, in the past, this ESG has been discussed and talked over, but the execution seemed to be happening this year. So we have companies that we help and decided to move from the current building to a new building because the current building is non-certified green building. Yes, this requirement comes mostly from the multinational companies, and it doesn't happen for local companies and also state-owned companies, mostly from multinational. If there are landlord here that is joining our webinar, we would like to give recommendation if your building is still not yet a certified green building, to consider applying for the green building certification, because when tenants are looking for a new office building, assess all the options. If your building is certified green building, there is a strong likelihood that you'll be considered as a shortlisted and probably be the final building to move to. Next slide, please. Now, this slide is actually we decided to share this to you. It's coming from the actually locator logic. They have an application identifying the mobile phone users to track down where the people are working in a submarket of Jakarta CBD area. So 2019 on the left-hand side, 100% numbers there as a benchmark is actually before the COVID. A lot of people work from the office, nobody working from home. And then we had COVID 2020. So it's reduced to 74% because we're forced to work from home. And then when the peak of the COVID-19 in 2021, Delta variant hit the highest, it went down to 29%. And then the good news is, as per October this year, it went back up to 45%. And then we're very sure that it will continue to go higher because of the COVID is getting reduced and reduced. But it will not go back to 100%, we believe. Why? Because the hybrid working system is still being applied by many companies, especially multinational companies. And then the fact right now, an opportunity for tenants, because demand for office limited and oversupply, tenants is also have the ability to move to a new building, better building, and get the very good rent. And then from the developer perspective, office activities coming back, it is recommended to remain flexible and accommodative, especially for retaining the tenants. Next slide, please. Now, this last slide is actually coming from the survey done by Institute Real Estate Incorporation. It happens in Europe, where 60% of employees prefer to do working remotely or hybrid system, and then 79% commute within 10 minutes from home. And the solution is easy from the one in Europe because there is a satellite office available in the suburban area of Europe. In the city of the suburban area of Europe, there are proper office building available. Now, going to Indonesia on the other hand is different. We don't really have proper office building in every suburban area of Jakarta. It's not as many as it is in Europe, but we believe it become an opportunity because generally speaking, employees in general would like to commute less. So this could become a trend. Could be a trend if there is satellite office being built closer to Jakarta suburban area. Then companies, not only multinational companies but also local companies would prefer to rent. So employees doesn't have to go and drive too long to downtown. They could just rent an office space, satellite office close to the house, and it will work better to organize between companies in the satellite offices and also in the downtown area. This last slide wrap up my presentation. I'll turn over back to you, Ruby. Thank you everyone for listening.
Okay, thank you so much, Pak Ferry and Pak Bagus for the presentations. Sorry. Next, we will have Pak Ferry to present about the retail market with Bapak Sender Halsema. So, Pak Ferry and Sender, the floor is yours.
Okay, thanks again, Ruby. Okay, here you have we have supply annual supply situation and the projection up to 2025. Unlike the office, supply for retail is not a big issue. For some years, shopping center has grown quite moderately. Even in Jakarta, we see limited supply pipeline starting in 2024. So meaning that this give room for recovery for retail sector in the future. Next slide. Okay, one of the indicators showing the start of retail business recovery is the amount of traffic in the mall, within the mall. As I said several times, during the pandemic, number of traffic coming to the mall dropped to only like about 40% of each normal time, mainly because of the people movement restriction at the time. But over time, it slowly recovers, and now it's almost 100% of the normal traffic. Although the occupancy level is still below 80%, as you can see in the left-hand chart, represented by the yellow and red line here. However, occupancy performance in the middle to upper class mall is relatively higher than in the middle to low mall. One of the reasons is because the upper class mall try to keep up with the dynamics in the industry and follow the current customer trend and needs. And then on the right chart, you see the difference occupancy performance in DKI Jakarta by its classes, and also compared to the performance in different cities in Greater Jakarta area. Next slide. Now, rent has been generally stable in 2023, but there is an indication that it might increase by at least like the value of the inflation rate. And this is the finding that we found in the market when we talk to the landlords. So basically, the landlord will seek momentum to increase the rent in 2023 because they have to bear the increasing cost for some time, and this has been since the pandemic, and they have not increased or adjusted the rent rate for since then. So we also see the maintenance costs may start to be adjusted in 2023 because of the increasing minimum wage regulation, and then the interest rate hikes, and also the inflation, and this will be taken into consideration in adjusting the maintenance costs. The overall property cost for retail sector is we think is about 7 o'clock based on the performance of the transaction volume. However, it really depends on the economic projection because it will greatly affect people purchasing power. And also we see that when there is the pandemic is can be curbed for some time, I think this will help improve the overall performance of retail business because there is no issue on the supply side. I think that's all from me. I'll give it to Pak Sander.
Okay. Good afternoon, all. Thank you for joining this webinar. During the previous webinar, I mentioned that we saw positivity returning in the retail market, and many retailers trying to reap the benefits of landlord flexibility and strong locations available for rent. In the second half of 2022, we saw foot traffic in several shopping centers has reached the same levels as pre-COVID-19, but the national average has just reached about 80 to 90%, as Pak Ferry also stated. Many shopping centers have stopped concessions in the second half of 2022, or to the very least, reduced them. Next slide, please. So if we look at the second half of 2022, a few shopping centers have increased their rent with a maximum of about 5%, mainly in the higher segment. But overall, also as Ferry said, there has been no increase in the rental rates. The same can be stated for service charges. But Colliers expects an increase in both the rent and service charge starting from sometime the first half of 2023. F&B continued to be the main driver of leasing demand in the second half of 2022. But we've also seen much activity in the grocery segment, with Ranch Market, Super Indo, and Grand Lucky being very active in the market. Furthermore, we've seen strong foreign retail brands like IKEA, Decathlon, with Gill Capital as their partner, and KKV opening outlets in Jakarta, but also in cities like Surabaya, Jogja, and Medan. And they really do that to further expand their physical presence here in Indonesia. For 2023, we expect this to continue and to have other foreign retail brands entering Indonesia to take advantage of the huge market potential that this country has. Next slide, please. If we look at shopping malls, the malls in the middle upper and upper segment have been performing very well since most COVID restrictions have been lifted. And they continue their upwards trend in terms of traffic and sales in the second half of this year. These malls will continue to do very well in the coming year. The malls in the middle lower segment continue to struggle to recover from the COVID era because of fierce competition in the Jakarta market and a more risk-averse approach from retailers in the middle-low segment in terms of expansion. Newer market entrants, like for example KKV, can help boost the overall tenancy mix and traffic for malls in the middle-lower segment, since such retailers will bring a fresh new concept and create a fit-out to their assets. This is very important because this is still what consumers are looking for. You know, they will go for retail locations that can provide them with a great experience and the right mix of tenants to spend their time with their friends and family at. Next slide, please. Retail and office buildings. The take-up of vacant retail space in offices has remained to be a bit disappointing in the second half of 2022. Although we see an improvement and more space being occupied, office landlords continue to struggle bringing in a diverse, healthier and fresher type of F&B tenant. So most retailers opening at office locations are convenience stores, pharmacies and F&B brands active in the QSR business. So basically fast food chains serving simpler, easier to make and less healthy food options. F&B, basically these are F&B retailers that are less impacted by the restrictions of operating a restaurant business at an office location. For the higher end F&B businesses, which involves fresh food and cooking, the restrictions of only being operational for 5 days a week with a single peak at lunchtime and many office workers still partially working from home, it often becomes too complicated to run a profitable business at an office location. Office landlords could consider to be a bit more flexible towards this type of businesses in terms of the rent and the rent structures, really to encourage them to open at office locations. Next slide, please. Yeah, e-commerce slows down, but is still higher compared to pre-COVID levels. Obviously, e-commerce sales really spiked during the COVID era due to difficulties consumers faced of going to shopping malls and other brick and mortar stores. Everybody in the market was curious to see if this peak would continue after the relaxation of the COVID measures. And it seems that's not really the case. Although e-commerce sales are still above pre-pandemic levels, 2022 has shown that the COVID era did decrease consumer appetite to go to decrease consumer appetite to go to shopping malls and to shop in actual stores. This is a phenomenon we do not only see here in Indonesia, but we see basically throughout Southeast Asia. So people have really returned to shopping malls and brick and mortar stores for their shopping. Next slide, please. Consumer confidence is a concern for many retailers. In general, the main driver for growing retail sales is consumer confidence, which seems to be at a century low now globally. Uncertainty in terms of inflation, pressure on household spending, on energy and basic goods is leaving many consumers anxious for the coming months. Especially retailers selling non-essential items will be impacted by this, as consumers' spending will be more limited to essential goods and services. Consumers, of course, are more concerned about preserving the value of their existing cash and covering their debts and day-to-day expenses than investing or spending on tertiary needs. It seems, though, that Indonesia, which has been relatively stable, also as Bu Monica explained, is not as severely impacted by this compared to other countries in this region. Next slide, please. So for 2023, and to conclude, although there are still uncertainties with the war in Ukraine, high global supply chain costs, and the inflation, we feel that the retail outlook for the first half of 2023 is relatively positive. Indonesia has been performing quite well in 2022 with economic growth and lower inflation rates compared to other countries. And consumers, we see, find their way to the shopping centers and seem to spend money. We also see both international and national retailers continue to invest in this country, although with a bit more caution. Expansion plans have been revised and are generally less aggressive, but retailers, as said, continue to invest in the country, which is a very positive sign for next year. That concludes my presentation. Thank you.
Okay, thank you so much, Sander. And next, we will move on to the industrial sectors. Pak Ferry and Pak Rifan Munansa, the floor is yours.
Okay, thanks again, Ruby. Okay, here I have two charts here. This showing the land absorption of the industrial land absorption, and then the transaction happened in some of the key industrial estate in the Greater Jakarta area. So throughout the third quarter 2022, industrial land sales have been relatively quite slow. We recorded this is the lowest during 2022 year to date. In this quarter itself, only 6 regions reported transaction during the period, and the total land sold during this quarter is only like less than 25 hectares, or less than half of the previous year's transaction. So the total transaction until to September 2022 were recorded at 139.7 hectares, or only about 63% of the last year achievement. And this means it's a big homework, especially because the period of fourth quarter is only like 1 month ahead. So if the transaction at the end of the quarter of this year is not large, then this year's achievement cannot match what was achieved in 2021. However, this doesn't indicate weakening in the industrial sector, as demand and plans to expand their production capacity still continue. And this is in line basically with what Mike has been saying earlier, that this sector is one of the healthiest sector. Next slide, please. Okay, here you can see the dominance of data center, almost 40% of the whole pie chart. So we still anticipate more and more transaction coming from data center companies, especially next year, although we have seen that expansion of this industry has been quite substantial for the last 3 years. The industrial estate have benefited on the other side from the regulation that requires hyperscale data center company to operate within industrial estate, and the fact that many modern industrial estate have facilitated this data center, because It provides more security, water supply, and most importantly, the energy supply. Other than data center, logistic market is still resilient, and also the automotive industry, particularly those absorbing high tech like the electric vehicle. And I think other traditional industry like food, pharmacy, building material have been quite consistent in growing despite in relatively moderate number. Next slide, please. Okay, this is the land price of industrial land, and since the pandemic, price of industrial land has been quite stable. Almost all industrial assets maintain their asking price stable for years, and but it is like you industrial only recorded. This concludes my presentation. I'll give it to Pak Rifan to continue on.
Okay, thank you very much, Ferry, for the industrial market outlook of third quarter 2022. Thanks everyone for joining this webinar session. Now, as we are already at the end of 2002, it will be interesting to know the industrial market condition post-COVID and the fact that we are facing the challenges in 2023, where the interest rate and inflation rate are slowly increased from time to time. Here is the industrial market update. As you can see, for the third and fourth quarter, actually we have seen that the new investment are on the wait and see mode. The external factors such as war and anticipation of the slowing global economic condition influence the decision of new investments. New investors tend to wait to decide, as well as investors that are already have their operation in Indonesia. They are also trying to postpone their investment decision for another 1 to 2 years, while they can maximizing the utilization of their current facility. Next. Inflation, inflation rate and interest rate. High inflation rate will trigger the increase of the development costs on the side of developer. However, we believe that market or occupiers may not be able to directly adjust the higher purchase price or higher rental rate. As a result, developer may have to sacrifice and accept a lower profit margin. On the other hand, high interest rate will impact developers who are still on development stage and taking loans. While I think developers who are selling existing industrial plots will not get any impact. The increase of the interest rate as well as inflation rate will slowing down the economy, as mentioned by Mike and my colleagues. Investors will expect higher return and they will try to press down the purchase price. So then we will find more distressed assets available in the market because property owners will get difficulty to sell their assets. So regardless the challenges that people predict for 2023, which majority will say the global economy will be slowing down, in our opinion, Indonesia industrial market still has a lot potential to grow. It has been approved that even during the 2 years period of COVID, industrial sector is still healthy and better compared to other sectors. So why Indonesia industrial market still promising? Next. We believe that our market is still huge and the existing companies, factories, logistic, e-commerce, and many others are still growing and expanding to supply and serve domestic market. Some Asian countries, such as Vietnam, for a certain industry, for example, like textile, garment, become saturated, in which less property option available in the market and minimum wage slowly increase. So actually, it is coming back to Indonesia, where we still have plenty of land and labor supply. Next. We have seen a stable market for data center, as mentioned previously by Ferry and other colleagues. Also, pharmaceutical industry. And as you can see, that data center is still leading the industrial land demand in the east and actually south of Jakarta, Greater Jakarta. Consistent demand from FMCG and e-commerce, even though the demand from e-commerce is not as fast as during the pandemic period, but it is still showing a positive trend and has plenty room to grow. We have seen a huge new potential market for electric vehicle. Currently, electric vehicle still at the preliminary stage, but electric vehicle battery, which is about to set up a new factory, which is includes the upstream and downstream, looks promising. Next. We predict Purwakarta, Patimban, and Central Java may become the destination for investors because government has been very supportive to Patimban and Central Java, building infrastructure such as toll roads, Patimban Seaport, industrial estate in Batang, which is Central Java to compare with other countries such as Vietnam. So government is building an industrial estate with attractive offers, like land is SGB on the top of HPL with a lease period of straight 80 years at a very competitive selling land price. And then the term of payment is very attractive, 20% down payment, and then the remaining payment at the beginning of year 6. And as well as the plenty of labor, which is with the minimum wage, is about 50% of what we have in Jabodetabek area. Also, several developers have significant size of land in Purwakarta area, which is ready to be launched to the market. As you know, Jakarta Cikampek 2 toll road, JAPEK 2, is under construction. And this definitely will support industrial development in Purwakarta area. Last, Patimban area is very potential, and then we have seen that will be ideal for electrical vehicle industry to develop their ecosystem, and which is will give direct access to seaport for transportation to sending to regional and domestic consumption. So based on the above opportunity, we still strongly believe that industrial sector is still relatively strong, and electric vehicle sector will be booming in the near future. That is from me. Thank you. I'll give it back to Ruby.
Okay, thank you so much, Pak Rifan. To the apartment sector, we will have Pak Ferry Salanto joined by Pak Steve Atherton. The floor is yours, Pak.
Okay, thanks again. Hello, everyone. Okay, now we are talking about the apartment market. So now I have a chart, supply chart here. So this is a combination of cumulative supply and annual supply with number on top of that. So we see that the developer during 2022 and 2021 are lacking of confidence in because of the current macroeconomic condition, and this is reflected in the absence of launching new projects. So you can also see on top of bar 2020 and 2021, the number of apartment product being launched is few more or less than what was achieved in the previous years. And then one of the reason is first the increase in the price of building materials, and then also the second one, the inflation, which is influenced by the global condition, and that makes developer become more careful in determining the launching time and the right pricing strategy. Next slide, please. I should correct the title. It should be price remains stable, not land. You should disregard the land word there. And as you can see in the left upper chart, the total sales of apartment during 2022 year to date was only like 282 units, or only about 61% of the total sales in 2021. And as you heard from Mike, that this sector is one of the unhealthy sector because of the oversupply situation. So that we estimate that this year's sales level will not exceed 2021 sales because of the below expected market condition, and also because of the limited stimulus from the government. Almost all apartment projects experience difficulties in selling their product, and some do not even record transaction. Moreover, since October this year, there is no catalyst to drive sales. The VAT discount is over and no more breakthrough after that. Apart from that, people tend to keep cash, and the secondary market has lots of on the listing because
Okay, I think there may be a problem with Pak Ferry's internet, but maybe now let's move to Pak Steve Atherton's slides. The floor is yours, Pak Steve Atherton.
Okay, thanks, Ruby. Good afternoon again, ladies and gentlemen. Broadly speaking, the apartment market is slowing around the region and the world. In the US, you may know there's a large multifamily for-rent apartment market, which has been rapidly expanding over the last decade. That's purpose-built apartments for rent. With the cheap money and growing demand, especially in urban locations where the jobs are situated. But now, with hybrid work and layoffs increasing in the US, we're seeing less new rental demand. Also, the rents are at peak levels now, while at the same time, we have the new higher interest rate environment. So the positive leverage enjoyed by many apartment owners is gradually getting reduced as borrowing costs are rising, combined with more skittish buyers demanding higher capitalization rates. This is resulting in fewer deals and expectations of less profit for the sellers. This situation has buyers and sellers in a standoff with fewer transactions executed. Also in Asia, we see similar standoffs where investors who invested in projects in the last plus or minus 5-year period are finding the buyers are not willing to pay lower capitalization rates expected by sellers. With higher interest rates, buyers expect the capitalization rates to adjust accordingly. So for now, we're seeing much fewer transactions in most of the major gateway markets across Asia. Japan is one of the few markets in Asia that still has a lot of private and institutional investor demand with their continued low interest rate environment. Next slide, please. For Indonesia, the global recession uncertainty and recent increased levels of job layoffs and/or job freezes has created further cautiousness. Cash is king, So most wage earners are looking to control or reduce their fixed expenditures at the moment, not increase them. Also challenging for the apartment market is the holding costs, the monthly maintenance, service charges, and property taxes, especially in cases where the units remain vacant. Also, while apartment demand has been improving somewhat on the rental side, investors are still wary to invest fresh capital for new purchases without the higher certainty of rental income. We're also not seeing healthy capital gains for apartment investments, which has been a further dampener on new purchases. Next slide, please. Also, with the hybrid work patterns that came out of the COVID pandemic, we're still trying to find the new normal for our office demand, business travel for city hotels, and apartment demand for urban dwellers. Until there's more clarity on the workplace and how often employees are expected to be in the office, there may be some continued hesitancy to commit to purchasing new apartments. Also, if the apartment price is not far apart from the smaller landed housing price, new buyers may be more willing to commit to suburban landed housing and longer commutes for the time being. Also, the suburban locations are getting nicer with much of the shopping, school, and entertainment options of more urban locations. Next slide, please. This current environment of rising interest rate and increasing construction costs is also making new launches of apartment projects very challenging. Lenders are more cautious at this time, and the job market is softening. So basically, there's caution in the air. Another factor that causes fear on the buy side is uncompleted, partly built apartment projects. Not only are partly built, stopped construction sites an eyesore, but buyers fear tying up their precious deposits and installment payments for a project that might get delayed for an extended period of time. Therefore, buyers will be much more inclined to purchase units in built, already constructed projects with ready inventory versus planned or even under construction projects. Also, developer reputation will factor in as well. Next slide, please. Also, when you look more closely at the take-up absorption pattern over the last 7 to 8 years, the apartment market has been on a steady decline from as high as 10,000 plus units per year absorbed in 2015 to more recent take-up in the order of 1,000 to 1,281 units per year. Even with fewer apartments getting built, we're still seeing 3,000 to 6,000 or more units coming on stream per year. Land prices are not, in many cases, adjusting downward to reflect the more difficult property development environment. In fact, with the recent increase in plot ratio, according to the new city plan, RDTR, many landowners are asking for even higher prices for their land, which isn't in high demand in the first place. So this is a mismatch of sorts and will get sorted out through the market process in the coming years. Next slide, please. We do expect opportunities for TOD, transit-oriented development projects in the coming years. Our MRT system is world-class. It's only one line, but it's world-class. And the LRT is expected to open in 2023. Eventually, as workplace occupancy finds the new normal, there will be urban types that prefer the convenience and lifestyle and affordability of apartment living, and especially in prime locations with supporting retail and F&B in the surrounding development. Next slide, please. As we've seen in most major gateway markets across Asia, there is high demand and premium pricing associated with successful transit-oriented developments, and we expect the same to be true in the medium to long term in Jakarta. Also, we see the high amount of office workers back in the office. When that happens, we will eventually get to higher demand for the convenient urban lifestyles where renters will also prefer to live in places more convenient to their workplace. This should bring investors back into the market but probably for more affordable units versus the luxury sector, which will be for more of the end user or a more limited in size rental market. Next slide. Even with the current land pricing mismatch between sellers' expectations and buyers' willingness to pay, for certain situations, circumstances will dictate a deal in the short term as necessary, and these may be attractive opportunities for buyers that are ready to pull the trigger. For apartment building owners who have a lot of completed inventory, 2023 may be the right time to shift to Plan B, where the units planned originally for strata title sales are transitioned with certain target markets in mind into serviced apartments, co-living, or branded residences with experienced investors and operators. That's all from Capital Markets. Thank you. Back to you, Ruby.
Okay, thank you so much, Pak Steve. Now to discuss about the expatriate housing, we will have Pak Ferry and also Ibu Lenny van Es-sinaga. Bapak and Ibu, the floor is yours.
Okay, thanks, Ruby. I should apologize. I will be off cam because my signal here is not that great. So let's start with the expatriate housing market. So at last, we see that the expatriate residential market has gained its traction because the number of inquiry reported by our consultant has increased, and landlord of favorite location become more confident now. The expatriate housing market also start picking up at this moment, and you can see on this chart more new expatriates have been arriving to fill in the position in the company or organization which were left during the last 2 years. And the inquiry for expat housing is now almost equal to the number prior to the pandemic. And interestingly, the origin of new incomers becomes more varied, such as many come from the African countries, Russia, maybe other countries. And the profile is also more diverse, as many new young age expat, and most of them come as a single or couples rather than a family with kids. On the other hand, we think that tenants should anticipate possible rent increase, which almost equal to the tariff during normal situation, and they might be required to agree on a longer payment term, meaning yearly instead of monthly or quarterly like during the pandemic. Nevertheless, the competition among landlords is now tighter since tenants have more knowledge and information, and the fact that they are also faced with more options. Over to you, Bu Lenny.
Thank you, Pak Ferry. Selamat sore, Bapak-Bapak dan Ibu-Ibu. Okay, from expatriate housing market, we'll see that in Colliers Residential, we see that very positive. And then, as you know, that in our previous webinar, I already mentioned that the H1 that growing, I mean that for the expatriate keep coming, and then a lot of demands in the property for the leasing property, I mean, and then we'll see that it's getting better and increase in 2022 until now. Okay, so it's very positive. And then the next, please. Like Pak Ferry that mentioned, that about the expatriates, we find the data from that the Minister of Labor that they keep increasing since 2021, and then well, from the data that we have, well, Pak Ferry mentioned about from the Russia, we have that just small percentage, but mostly that the nationality that we've seen that still the Korean, China, and then US combined with the European, Europe. And well, as you know, this is that very positive for the expat housing market, and then both landlord and then also the tenants, they keep, I can say that the compromise, I mean, more flexible for the landlord. And then we've seen that in the next slide. Bang Jo, next slide, please. Oh, sorry. This is the slide that mentioned about the global recession. Okay, so as you know that the global recession, that it's gonna impact for sure for the expatriate housing, for the expatriates coming to here, and then as their company also affected, their unstable economic condition, where their company come from, let's say that the head office maybe from Europe, you know, and then they have to hold that some expat coming to Indonesia. So this is the effect of the global recession, and we're hoping that this is not in 2023, it's not really affect to that Indonesia for the expatriate housing market. Next slide, please. This is quite important, yeah, for the opportunities in 2023. So what we've seen in opportunity in 2023, like I mentioned earlier, that the landlords and the tenants still the same like in the 2022. So we've seen that the high demand that for the landlord side, the landlord know the market getting better, and then after the 2020 and then 2021, in 2023 they're hoping that they can increase their prices. So which is that I think that still makes sense, yeah, because the rental also, the second point, that the rental period also in the 2021 2022 they're still flexible, the landlord that to give like a 6 month to 1 year, but we will see that starting now that the landlord that prefer like a 1 to 2 years minimum. Okay, and then for the tenants, well, the rental that remain stable, but some of the high demand properties, we've seen that it's it's challenging, yeah, to get that the good properties, I mean, for the area, expatriate living area. So this is gonna be for the companies, has to be I can say that see the market in 2023, because we'll see also that this is gonna be that depends on the property market, yeah. And the second point, that some landlord also that still flexible with the tenant wish list. Why that I put in here, in the 2021 and 2022, there's the company is very strict on the requirements. So the landlord that trying to fulfill that all the requirements, and then flexible on the rental period and everything. So we'll see that in 2023 the landlord still trying to there is some flexibility in here, and then compromise, and then to get that tenants, yeah, in their property. Next slide, please. Okay, so in this slide that I think that Pak Mike that mentioned opportunities in 2023. Earlier that Pak Mike mentioned that good news about the foreigners now that can have that the right ownership over stack units. So that are built on the land that has hak guna bangunan, right to build, or hak pakai, right to use. I think that this is that it's a good news for the foreigners, yeah. So before that they have to have the the permit, special permit, and then now that the government that agree that for the foreigners can prove the ownership of visa, passport. So this is the flexibility, and then the from the government, I think we'll see that in the 2023 that give that the positive, for the apartments and landed housing, and then as you know, that minimum that 5 billion for the Jakarta and then in Java area, province. I mean, so this is also that it's gonna be challenging, and then I think that I can see that we're hoping that the foreigners can use this. I think from the government, for the opportunities in 2023. And then also that from that, we'll see also that in 2023 for the expatriate housing market, I'm pretty sure that if there's the company and then the landlord keep working together and compromise, and then flexible on their terms and condition, I think 2023 that will be that better than 2022. I think that's all from me. I'll give it back to you, Ruby. Thank you.
Okay, thank you so much, Bu Lenny, for your presentation. And last sector, now we will discuss about the hospitality sector. Please welcome Pak Ferry and Bapak Satria. The floor is yours, Pak.
Okay, thanks, Ruby. Next. Okay, as I think this title in line with what Mike mentioned earlier, we can say that hotel performance, especially in Jakarta, shows a promising positive indicator, particularly if you look at the occupancy trend as shown in the left below chart, and also the influx of more foreign visitors in the upper left chart, coming to through Ngurah Rai Airport in Bali, and also coming through Soekarno-Hatta in the Greater Jakarta area. So the increasing number of business trips organized by the government, corporation, or individual is enough to help increase the level of hotel occupancy, and the start of many offline activities also help boost the level of occupancy in several regions. As the occupancy rate increases, the monthly ADR figure also slowly increases. And you can see, and in the next slide, please. Okay, until the end of 2022, it is estimated that hotel performance in Jakarta will experience an increase. One of the trigger is a series of G20 event activities, which still take place at least until the beginning of December 2022. And also in addition, there are still quite a number of offline activities agenda, such as a music concert in Jakarta, which is potentially for growth, for hotel. Then in 2023, it is estimated that number of foreign tourist visit will increase also, so that there will be a potential for hotel performance to improve. This is a momentum for hoteliers to prepare to receive more guests. And then for this slide, it's showing Jakarta hotel performance. And the next slide also will show the Bali hotel performance. This is a similar chart. We try to differentiate the period before the pandemic, which is represented in the red line. That was for 2018 and 2019, and the situation during the pandemic, and now which is represented in blue line, and this is from 2020 and 2022 year to date. So the overall performance along 2022 has been approaching the performance level before the pandemic. If you see from the chart, which is the darker blue, even for Bali, it's trying to catch up, but the trend is already in the right track. Next. Yeah, sorry, that's all from me, Pak Satria. is yours now.
Good morning. Good morning, everyone. I hope that it's still in the morning because it's always be the hospitality is the one who is at the end of the presentation. So yeah, as what Ferry mentioned, actually we are back. We are coming back. We are in the numbers that we are aiming since the past 3 years. And I believe that it's not right also if we don't say to you that the performance of the hospitality industry currently now this month is much better already than 2019. If you see the charts, the previous charts that you saw that Ferry mentioned, actually our performance is up to August, and you see even the Bali occupancy, we only achieve about 60+% in August, but actually currently we are more than 80% compared to 2019. And the worst actually for us as a customers of the hotels is the ADR is also increasing, which is the ADR is even higher than what we are expected to be. So we are in a position that better than 2019. Okay, I would like to share some thoughts. What are we going to face in the next few months? The next slide, please. Okay. Everybody is questioning what is going to be this industry, especially because of the inflation that is already mentioned several times, the crisis that have been haunted us for a while already. If we put ourselves in the past 2 years, actually we never be in the bottom again. The problem during the pandemic is that nobody travels during the pandemics. But during the inflation, during the crisis, everybody still travels. So how will the inflation will impact to our industry? It is going to be impacted for sure, because the longer the inflation will be, then all the costing is going to be increased. The pricing of the hotels, the pricing of the airline, the cost of the fuel are increasing. But we always remember that we will never go to the level of pandemic again. So be there. Next slide, please. Will the possibility of the global recession weaken the hospitality performance for next year? This question has been raised almost every day, and most of the industry practices, they all questioning me what is going to be, what we have to do to prepare that matters, especially for next year. I believe that everybody have been go through few crises since 1998 till today. I also enjoying myself how's the crisis that happening in 1998 and also 2004 and 2010. When the crisis come, when the recession come, actually people is still travels. They need the distraction. Yes, they might not travel as more as the period that is very enjoyable, but they still travels. This is a challenge that we need to make sure that our business is there and the hospitality performance will be there. The next slide, please. the condition of 2023, there is two things that we are going to face. The first one is the political years of 2023 because of the president elections, because of the governor elections, because of the DPR, MPR election, and so on and so forth. But for us, the political years are one of the distribution channels that we are waiting for every 5 years. This is the time when we normally also gain some revenue, gain some profits because of the activities of political year. So is this going to be a plus or minus? It's going to be a plus. And I need to make sure that everybody will get ready for that and make sure that you are prepared for that. The second condition is on the next slide. The opportunities on the 2023. Everybody also asking me what happened with the 2023. First is because of the political years, the one that have been answered, and the second is because of the crisis. We are now in the states of increasing everything, the occupancy, the average room rate, even the cost is increasing, even the price of noodle on the street is increasing, even the fried rice on the street is increasing. But in 2023, actually, we have to see it from the other angle. Look, currently there is a few opportunities that we are still waiting. We are aware there is a news that if you fly from Australia to Indonesia, especially to Bali, from today until the end of February 2023, you might have difficulties to get a flight until February 2023. And after that, we also heard about what is going to be happening in China. The people in China is not on the state that they can go anywhere in the world easily for the time being. But I do a few surveys, small survey in the past few weeks. I try to see how the airline is doing. For your information, there is a few airline company now, they are already offering their flight come into China and go out from China from the March and April of 2023. So expect the positive things that might be happening in 2023 April and onward, because the big numbers of visitors that we are planning, that we are waiting for the past 2 years, will be coming during this period. And for them, for the operators, actually, we are also recommend that most of the operators, the management of the properties, try to see all that indicators, that not only the one on your dashboard, but see the indicators from the other people's dashboard, for example, like airline, online travel agencies, and other sources. Okay. The next slide, please. I also see that there is an opportunity, especially for us who is managing budget hotel operators and also the small hotels. This is the time. The crisis is a time when we can develop ourselves and present it ourselves to the higher level of customers, because the people who travel are the one who is on the mid and up level of customers that is available. The low level of customers, they might calculate, they might consider, they might think 3 times, 4 times to travels, but they still travels. But the mid and high customers, they still go. And we also recommend that all of the industries, they need to see how we can increase our services and our manpower, because That's the easiest way. That's the cheapest way to increase our value of the property and our product. And the last one that we are aware, the visa on arrival that is now opening for more and more countries. This is another opportunity for us that we are going to have more guests during 2023. So be there, be happy, and try to make sure that that we are part of it. Thank you.
Okay, thank you, Pak Satria, and thank you to all our panelists for their presentation. Now it's time to have a question and answer session. So we already received some quite interesting question in our chat box. So let's start the first questions. I think maybe Bu Monica and Pak Steve Atherton can help to answer Pak Tito question. So you mentioned before there is a possibility of more distressed assets sales next year. Do you think there is still appetite for local companies to do this kind of deals, or it will be primarily cross-border deals? Maybe Pak Steve can help.
Thank you. Very good question. We're working directly at the present time with quite a few local investors that are looking for distressed opportunities. So it definitely will be opportunities there for local and foreign investors, and to a certain degree with problematic situations where there's distress and it's complicated. Local buyers may in fact even have an advantage.
Okay, and then there's also questions from Iwan Kurniawan. He asked about how the IKN program, the new capital city of Indonesia, will impact property market in Jabodetabek, and how the political years in 2023 and 24 impact to the market. Maybe Bu Monica or Pak Steve can help also answer these questions.
Okay, I will try to answer for the IKN, the impact of IKN development. Yes, in somehow the IKN development will have some impact on the property market in the Jabodetabek, but it is because nowadays the government has set up some regulation or some policy that they will commercialize some government assets in Jakarta to become part of the financing or funding for the development in IKN. Maybe in general, this will not really impact on the commercial. However, some of demand for office are also coming in from the state-owned companies. And these state-owned companies are those who maybe have to set up business or to have to rent offices in the ex-government offices. So this in somehow will have the impact because the government has really set up the policy to commercialize the government assets in Jabodetabek. So that's it. Maybe for Pak Steve, do you have some additional information, Pak?
No, I don't think I could add anything to that, Monica. Thanks.
Okay, then maybe now we're going to move to office sector. So there's quite some questions for Pak Bagus. So Pak Bagus, there's a question from Ibu Agni. What are the implications of the alternative growing business to the office space inquiries?
Oh, maybe we need to ask her back what is alternative growing business is referring to.
Okay.
Yeah.
Maybe then this question can be answered directly via email ya, Bu Agni ya, with Pak Bagus later on. Okay, Bapak, the next question came from Pak Taufan Budiarto. Pak Bagus, could you share the forecast of service charge rate increment for 2023?
Service charge increment has always been following the inflation rate, that mostly determined by the increase in the gasoline, minimum regional wage, so electricity tariff. And then this 2023, I think we project the inflation rate will be around 4% So I think it is safe to say between around 4% numbers. But the calculation of increasing the service charge is also not that simple, yeah, because every developers will have to calculate whether or not the cost of increasing the service charge, how much will that be, depending on the total operating cost of the building. So the formula is not fixed, you know. It says inflation 4, it will increase 4%. So it will depend. Go back to the calculation, what is the actual operating cost of the building, and then it will increase gradually from that numbers by each building owners. But inflation rate is the guidance towards that calculation in general.
Okay, maybe last question nih Pak Bagus from Bapak Herdiansyah Shiva. As company tend to reduce their office space, how many square meters of space is becoming the most demanded by them? And the second question will be on the opportunity of satellite office. Will be ruko or shops, landed house or office space in suburbs? Maybe Pak Bagus can help.
Yeah, about downsizing of the office space, the reason for that is because of the hybrid working. After COVID, everybody do a hybrid, working from office and working from home. So normally each company will have their own calculation, what kind of hybrid system they will apply. Is it 50-50, is it 60-40, or 75-25, or 80-20? So it will depend how many square meter they will end up to, you know. I mean, we see our client from 2,000 square meter reduced their space when they renew to 1,500, you know, so about 20% reduction. But we see our client reduced by 40%. So it depends on each situation of the companies. But if you're talking about demanded ideal space that mostly asked by many companies nowadays, we see actually I would say between 300 to 600 square meter is generally speaking what is happening in the market right now. Inquiries that is coming now. About the what is the second question? The satellite office. About the satellite office, what I'm referring is actually proper office building. It's not shop houses. So it's a proper office building that is not common yet in the suburban area of Jakarta. That's the reason why the concept of satellite office is not becoming a trend yet in Indonesia, while it is becoming a trend and has been going very well in Europe or United States, simply because the employee will commute less, and at the time of the COVID, you know, the infection will become less too, you know, to get infected of COVID, you know. But because hybrid working system I believe will still be continue in the next few years, so satellite office could become a solution to many multinational companies. Instead of having the employee traveling through public transportation down to the downtown office, they could rent a satellite office close to their homes, you know. But the issue right now is there is not every sector, every area of Jakarta suburban area have proper office building. So that's the challenge, and that could become an opportunity in the future.
Okay, thank you, Pak Bagus, for all the answers. Now we're moved to retail. So basically, Sanders, based on your observation or Colliers' observation, what kind of retail concept or trend that will look growing in 2023?
I think there's not one particular concept. I think in general we still see that experience, entertainment, and F&B are taking a higher percentage of the shopping centers total space. That might continue to grow a little bit going forward. So I think there's a general trend that people that visit shopping malls do not necessarily go there for shopping of fashion or sport accessories, but really for the experience, for the F&B, and spend time there with their families, especially here in Indonesia. And there's some, like KKV, for example, there's some retail concepts that have a really great fit out, and each store that they open has a different kind of fit out. So those are really also crowd pullers, and you know, to have a very good and attractive fit out is something that is also pulling in a lot of consumers, I think.
Okay, thank you, Sander. Now let's move to industrial sectors. For Pak Rifan, there's a question from Bapak Charlie Nuzuli. How the progress market for data center, automotive, such as maybe from Korea or China, and then the electric vehicle battery, electronics, and FMCG in 2023. Which one will be the highest percentage? Maybe Pak Rifan can have the answers.
Okay, Ruby. Yeah, to answer the question, as mentioned in my presentation, that data center is still the one that is quite active right now, and electric vehicle is like still at the beginning. I mean, the other way around, and not really FMCG, but logistics is always growing, which is those are the two sector that dominating, which is data center and FMCG. So I think that's that will continue to happen in 2023.
Okay, noted, Pak Rifan, thank you. So move on to the apartment sectors. There's a question from Mr. or Mrs. Tin Yik Chu. So the interest rate is expected to increase again in 2023. So the question will be, how or why 2023 will be the excellent opportunity to buy affordable apartment for individual end users? Pak Steve Atherton.
Okay, thanks. Good question. Yeah, the interest rate is rising. In central bank policy has been increasing rates incrementally, but we haven't seen the rates here rise as much as some other markets like Europe and the US. But in fact, you're right. The interest rate is trending upward. So the cost of borrowing isn't going to get any cheaper in the short to medium term. But the prices are attractive because some owners of apartments need to sell. There's urgency. So we're seeing prices dropping in many cases. So it's not that you're going to get better interest rate or lower borrowing costs, it's you're going to buy it at a better price. So that's why 2023 is a good opportunity for buying apartments for end users. It may not be as attractive for investors that still have to find a tenant in order to get income and cover their service and maintenance costs. But, you know, maybe primary market, you know, the developers that are building new apartments for sale, they may be more resistant and less likely to lower their prices, but they also have the advantage of having a marketing plan and strategy where they can sell at lower prices now in a very difficult environment and plan for price increases as they get further take-up. So even the primary market, I think, can offer some attractive prices in order to get the party started and, you know, get some take-up and momentum for their projects. That's all I have for that.
Okay, there's another question, Pa Steve Atherton. So, how will the apartment construction be in 2023? Will there be more and more aggressive compared to 2022, or there will be no changes?
I think Ferry's slide reflects all of the data that Colliers has on projected new supply. And from recollection, new supply between 2022 and 2025 is like somewhere in the 3,000 to 6,000 units per year range. So best that we know based on our data is that's roughly the number right now. And actually, the fact is the amount of take-up recently has been only on the order of 1,000 units per year. So we still have a shortfall, and until I think the office market improves and the workplace is more crowded with people who have a reason to be in the office buildings and might have a reason to want to live closer to where they work, that's when we'll start to see a healthier apartment sales market.
Okay, thank you, Pa Steve. Now, there's questions for the expatriate housings. So basically, which area are considered as a high demand, and what kind of property is the high demand for the expatriate housing? And also in Surabaya, how is the market? Is it still the same like in Jakarta? And what is your projection, Bu Lenny?
Okay, so first question, yeah. So I think that this for the expatriate area here, still the high demand that close to the international school. I know that the last family is coming since last year, but there's still that's close to the international school that still the expats still interest in that area. Kemang still, Cilandak, Cipete, and Pondok Indah. So that's the favorite area for the expatriate. Okay, and then house compound, and then the complex, yeah, gated houses that's still the high demand, yeah. Even that the percentage of that apartment that's increased, yeah, for that the single and then the couples coming more that since last year. But we'll still see that the company that's more focused to put their expatriate in the complex or in the compounds and apartments. And the second thing, that's the second question that about the Surabaya. Well, the market there, a lot of expats coming for sure. There's a lot of project there, but the companies for the leasing that's more concentrate to put their expat in the apartment, either a service apartment or unserviced apartment. So for the market, for the housing there is not. It's very limited, yeah, not much compared to Jakarta. But for the selling, the houses, a lot of that we saw that selling houses for housing for selling, you know, so that the landlord that's more focused to sell their property than to list their property in Surabaya. So that's what we've seen that since last year until that last month. Yeah, I hope answered the question. Thank you, Ruby.
Okay, thank you so much, Ibu Lenny. So next question will be for hospitality sectors. Pa Satria, there's a question from Ibu Agni. What's the most marketable price range for villa in Bali? And then there's also questions about, let me check. Yeah, maybe you can answer that first, Pa. I will go back to you with the second question.
Is this the pricing for purchasing the villa or renting the villa for living? I believe this is the pricing for the villa to purchase the villa, right? So The price of the villas in certain area in Bali is so variety. For example, that we are talking about Canggu. Canggu is been hip since the pandemic. Even though there is a few area in Canggu like Brawa, Canggu, Prerenan, Pantai Lima, and so on and so forth. The pricing on this street, even though the distance is not even 500 meters far away, but the difference is huge because of the demand. Currently, Canggu and Jimbaran pricing of the villa are the highest among all of the area in Bali. And the price of the villas actually is also depend on the size of the land that is located of the villa itself. With the standard of 400 square meters size of the land with 200 size of the villas, for example, right now in Jimbaran and Canggu. Actually, the range price is about 4 to 4.6 billion rupiah. But have in mind that every time we would like to do the purchase of the villas, make sure that you are aware of the land status of the villa itself, because we are aware that most of the status of the land in Bali are not the freehold kind of land, but only for a long lease land. And this long lease land is cheaper compared to the freehold kind of type of the land. Ruby, over to you.
Okay, and the last question will be, what will be your insights regarding premium villa and restaurant market in Bali, Pak Satria?
Sorry?
Villa and restaurant market.
Villa and restaurant market.
Yes.
The villa business in Bali actually have been in the market and been one of the prime type of accommodation that is on the market since even before pandemic, and is still going to be there because people is going to find the same standard, the same feeling of Bali, which is they can find it better in the villa kind of accommodation compared to the rooms accommodation. Meanwhile, the restaurant business in Bali, I can say now actually the restaurant business in Bali is never stopped unless the restaurant is located in Legian Street and Kuta area. That is currently until now is still trying to survive, even though the market is back, but the business is crawling. It's not running, but it's crawling. But in the other area called Canggu, Ubud, Jimbaran, Nusa Dua, and other area, the restaurant business is there, is positive. Thank you.
Okay, Bapak Ibu, since we're already 30 minutes overdue, I think that was our last questions for today. So it means we're going to wrap up our webinar for today. For information, we will send out link to access the recorded webinar along with the presentation slides. For any question that are not answered today, will be answered directly via email to everyone. And then if you have any questions, please do not hesitate to contact us via the email that is mentioned on your invitations. And we also have a survey ready after you end this webinar, and we are really appreciate if you have time to fill out the form. So thank you so much to all participants that have already joined us today, and to all our panelists. Also, thank you so much for your presentation and for your insights. Stay healthy, stay safe, everyone. Have a very nice day and a happy holiday to everybody. Bye.